So does the type of loan that you get really impact the overall investment? I do think it does. So whether you get a 15-year loan, whether you get 30-year, whether you can actually get one of those loans that actually goes up to 40 years, that could actually increase your cash flow. There are things to consider, pros and cons. Sometimes it could cost more if you're doing a DSCR loan versus just a conventional loan, like for your primary residence, if you're going to do any type of house hacking, right? I mean, those loans can sometimes be the most attractive, right? They have typically the best terms. It's a lot harder to get just because you have to provide a lot of different documentation, income proof, debt to income, all those things have to come together for you to get the, I guess, what you would say is the best option. But if that's not the case, or you don't want to go through all that, or you've exceeded your amount that you can get from Fannie Mae, Freddie Mac, and you have to go the DSCR route or other options, that's fine. But you do have to consider those. What's going to be best for you? Do you want cash flow? Do you want to just build up as much equity as possible? And some people say that if you get a 15-year loan, that if you wanted to have the same effect, you could get a 30-year loan and just make extra payments. You can break down the math on that, see whether that matches up exactly how you want it or not. But basically, yes, there are ways to make things, I guess, similar, even if you don't have the exact same product. So, I mean, it is possible, but you do have to sit beforehand and think, what are my goals? What is my strategy from the beginning? And not try to do it on the back end. Don't be locked into something and then say, well, now that it's like this, you should have the game plan. You should have your trajectory, what you want to do before you even go into an investment property. So this property, I definitely want a cash flow on. I mean, I guess all of them you should want a cash flow. I mean, in an ideal world, but there are going to be times you have to kind of have a give and take. Some markets have much greater appreciation versus cash flow. Some have more cash flow versus appreciation. Some different types of properties, right, have different cash flow versus appreciation, right? And then there's times where you can get kind of the best of both worlds, sure. So it does depend. But I think the bottom line, what we're trying to get across here is that you do want to have the game plan before you go into it and not be trying to play catch up and trying to discern a way forward after you've already gotten into a property. Now you're saying, well, now that we're here, now that this is what the loan product we have, if we want to refinance, well, maybe we can go in this direction. Hopefully you can have that plan beforehand. And, you can't foresee every possible, possibility. But in the general scheme of things, you should have an idea of what you want to do, how you want to use this type of asset, and whether you want that to be the leap stone to the next one, or whether this is going to be your set path going forward. Anyway, so I hope this was helpful. I'll be sharing more about different loan products we've used for our different properties, and to see what might work best for you in your particular situation.